Today we have a treat for you. We often get asked, what are some of the biggest portfolio red flags? Well, today Jonathan and I are going to discuss these. Let's dive into it. Hello, my name is Will Allen with Sentara Capital. I'm here today with Jonathan Brummel. We are super excited to talk to you. We recently added Jonathan to the team. He has a long background in the industry. And so today, the Sentara Spotlight, we are talking about portfolio red flags. Jonathan, I know this is something that you've paid a lot of attention to over your years when people have statements and they sit down with you.
Yeah, so one of the things we talked about is how we mutually care about the portfolio for clients. It's one of the things that when we first started talking, the fact that you were doing videos about the market was huge because a lot of people in the industry, they don't even want to be out there with, hey, this is what my prediction, this is what my thoughts are, or they just don't know their stuff. And so I really like that you put yourself out there that way and that you thought through what's going on with the market. And so when we started talking and just going through the videos, now we were talking about, hey, why is this important? Why do our clients, why should they care that we do the market updates? And this puts it together. And so I'm really excited to talk about this with you and get your thoughts and ideas. These are things that you've been doing, I've been doing for years and decades now, but it's kind of lifting up the lid a little bit and letting you see, hey, when you come sit with us, what are we looking through? What have we seen? What are the good, the bad, the uglies? We've seen all kinds of things over the years. What are they? Why do we care? Why should you care? So I'm excited.
Absolutely. And so today we're talking about portfolio red flags. We want to mention, and this is something exciting, is that you can go and click the link in the description or go to sentaracapital.com right on the front page there, and you can subscribe and we will send via email to you. This is basically a 4 or 5 page document of some of the biggest portfolio red flags. We're going to cover 3 or 4 of them today. We have over 12 there that we can send to you. And with that, let's start with the biggest red flag. And one of the things that I think jumped out to both of us when we got in the industry, we were shocked that most advisors, when they sit down with a new client, they don't do a financial plan. And why does that matter? Because then there isn't anything, there's not a North Star to guide how are we investing your money.
Right. It's the whole reason why you have, we use benchmark terms in the industry. Like, so what's S&P 500 doing? What's international doing? Et cetera, et cetera. But it's a North Star for us. Why we have to have a barometer of where we're at, where we're going, and how we're measuring ourselves. And so that all starts with, when do you need the money? What's your timeline? What's your financial plan? And most people don't do that. Most advisors, it's about a product. There's some great products out there. Could be appropriate for the client. But most of the time, they're out there trying to position a product, not actual purpose.
Yeah, that's absolutely true. And I think we have an example to walk you through of how damaging this can be if an analysis is not done. And so for that, we start talking about a woman named Diane. And this was a real world example that she sat down with me and she basically said, hey, I'm 62 years old. I want to retire at age 67. And her income needs, she went through and decided, hey, I'm going to need about $5,000 a month. And when we did a breakdown of her income, she said, hey, got Social Security, that's $1,700. And I've got a pension, an airline pension of $1,300, which you don't encounter pensions that often these days.
No, it's unheard of really now. They went to 401ks back in late 80s, I believe.
Yep.
And by and large, most companies don't have any kind of pension, so you're stuck with Social Security or your investment portfolio.
Yeah, that's basically all. She did have a pension, that was nice, but even with the pension, she had about a $2,000 a month shortfall. And so I asked her, I said, okay, so tell me about your investments. What's there to fill the gap? And she said, well, Will, that's one of the big reasons I'm sitting with you. She said, prior to 2008, I had around $500,000 in an investment portfolio. And I said, that's great, because with that, you could know I could draw over $2,000 a month. I could fill that shortfall. In other words, she had met the goals. She was set for retirement. But the advisor didn't do that analysis, had her in 95% stocks, and that $500,000 portfolio dropped to $260,000 in the year 2008. That drops the income down to just over $1,000 a month. Now she has a shortfall of over $1,000 a month. And unfortunately, this case we have seen time and time again.
Yeah, I mean, we see it all the time. It's putting time horizons on your money. And so what we're trying to do as a financial advisor and planning is make sure if you're set to retire in a couple of years, we don't and '08 happens again because we can't ever fully predict the market. Well, are you set up for success? Can you still retire in 2 years? The worst thing to do is what hurt a lot of people back in the '08, '09 was they weren't quite ready to retire, but they're getting close. But they were too risky. They were too much in the market because everything's going up. So why not be in there? And the market corrects on them when they're supposed to retire. And then guess what? They had layoffs. They were forced into early retirement. And all of a sudden, they're left scrambling and they're having to take from portfolios that are down 45%.
And we also see a lot of the opposite side as well, especially because you came from the bank side recently, and you were telling me a couple of examples of people who were very young. Do you want to give that example to the folks today?
Yeah, so we were talking about this earlier. You talked about and recency bias.
Yeah.
In fact, talked about that, and then I'll tell you my short
Yeah.
story. So recency bias is whatever your last experience has been, right? It ingrains in you, and that's how you see the world, right? It kind of starts becoming your worldview. And so, from a recency bias, I was meeting with a guy who's 45 in his early 40s, and he can retire potentially in his mid to late 50s by the amount of money that he has. But from a recency bias standpoint, he, at one point in time, he decided, I'm going to play the market. Everyone else is doing good. So whether it was, I don't know, I don't think he did GameStop or some of these meme stuff, but he tried the market and it burned him because he didn't do it right. He was just kind of playing around, wasn't really paying attention. And so it tilted his viewpoint, and all of a sudden he didn't want anything to do with stocks. So you have this young person that has 10, 15, 20 years before he even touched like his 401k.
Yeah.
And he was all in cash or bonds. He had almost nothing in the market. And it was terrible. But explain to the people, why is it terrible? Why is it terribly in cash and bonds?
Yeah, great point. Okay, and that brings us, speaking of recency bias, to the risk tolerance questionnaire. And we have seen that this has been an industry standard basically in the 90s when I started and all the way through, where basically a new investor sits down, they are asked questions about how much risk they can tolerate in their portfolios. And what we have found over the years is that how somebody answers this is going to depend on what have the markets done recently. That's not a way that you would want to make other key decisions, like if you went to a doctor's office, okay? And we gave this whole example. If you walked into a doctor and you sat down and they came to you and said, hey, before you start talking about some of your symptoms, I got a question for you. Do you want red pills, blue pills, or green pills? And you think, what now? That's a kind of an odd question. And you'd say, well, red's my favorite color, so I guess I'll go red. They write out a prescription, they hand it to you and say, hey, take that in, start taking this medicine. Very good chance that you're going to do well with it. Pretty good chance, though, also it may not work and you'll die from it, but that's a smaller chance than the good happening, right?
Right.
We would never be okay with that. But that's exactly what we're doing with the risk tolerance questionnaire. It's how do you feel about the market? And that guides how we invest your money.
Yeah. So, I mean, you did a video because I did my homework But you did a video a few months ago that was talking about kind of what should you be expecting and why should you be investing in the market or bonds or whatever the different segment is. But that's key because it shows why you should take the risk because you're trying to get this type of an outcome. And so what we're trying to do is not say because we want that type of an outcome, but what do we need the outcome to do? And so when I was in the banking, I was in the banking world and private banking and stuff. When we do the financial planning, they might ask some of the right questions. What are your goals? What are your objectives? But very quickly, it's followed up with, well, what's your risk tolerance? You know, if the market drops 45%, are you going to be okay with that, Will? If your portfolio dropped 50%, would you be okay with that?
No, I would not be okay with that.
So we're all in agreement. We wouldn't be okay with that. We'd probably be freaking out a little bit. But it's all context. Why are we down? What are we trying to need? Do I need this money next month to pay for my house bill and I'm down 50%? Or do I need this money 10 years from now? The risk questionnaire doesn't do that. It's the recency bias that you're talking about. And so they ask the right questions of your goals, objectives. I want to take a vacation, leave money to my kids. But then they let it all be dictated by this risk. What is your risk tolerance? Not by, hey, because this is what you're trying to accomplish, we need to take a little bit more risk with this part of the portfolio. Because of what you're trying to accomplish, we actually need to pull back and not be as risky because you need the money sooner than that. And we see that all the time when we go through portfolios, when we start matching what is the portfolio mix up and what is it supposed to do, the outcomes, the variances, compared to what you need it to do. And we see huge disparities all the time.
So the main takeaway here is, and we're going to cover some other portfolio red flags, but the biggest one is right off the bat. If you have not had a retirement plan, a financial plan done, if your allocation is dictated by a risk tolerance questionnaire, that is a major red flag. Okay, now we're on to red flag number 2, and what we're talking about here is following outdated industry rules of thumb. Our first focus is an over-reliance on investing internationally. This is something that became very popular back in 2010-11 after international, and let's think about international outperformed the US from 2000-2010 because you had the dot-com bubble and then you followed that up with the financial crisis. 2 different sell-offs of over 50% in the stock market. International did a little better. So all of a sudden, BlackRock and Merrill Lynch and all the big firms decided, hey, everybody who has stock market exposure, they need to have a lot of that in international stocks.
Yeah, and so that's one of the things, like when we're talking through this, the red flags, these are things that when we go through the portfolio, we can quickly go, if you have this, what else might be wrong? It's the canary in the coal mine, so to speak.
Yes. Yeah.
If you have a ton of international stocks, which we see all the time in portfolios, that probably means they're using a very cookie cutter portfolio. They're using something very standard in the industry, and it's a complete CYA.
Yes.
French there, but
yeah.
But I mean, that's what it ends up being.
Yeah.
And there's reasons why. And so it's a canary in the coal mine that they're not being very intentional on how they're directing your investments and therefore your future. But especially international, this is why we pinpoint that, because how is it done?
Yeah, and that's, so in 2010-11, that's when it became really popular to move a lot of your money into international. Here at Sentara, we, if you look over the last 10 to 15 years, have had very little to no exposure for most of the period of time. And if we take a look at the returns on your screen, you'll see the chart here. From 2010 through 2024, that's a 15-year period, the S&P 500 up over 700%. You can see there. And if we compare that to emerging markets, up basically nothing. You have made virtually no money being in emerging markets, which emerging markets we're talking about China, Brazil, Russia. Those were very popular investments along the way here. And then we also have here international developed. So we're talking about Japan and Germany, Spain, a lot of the developed markets. You can see here, you have made around 36% in 15 years. So, yeah, so someone who has been loaded up with international and emerging markets, has dramatically underperformed. And guess what? This has been very popular with advisors who like to stick to just 4 or 5 funds in client portfolios. And we had recently a client of ours who had invested this way, their advisor had invested this way for a long time, and they said, we had met 10, 12 years and had made almost no money at all, and asked the advisor, and they were basically proud, well, at least you're up.
And that's what we don't want to do, right? Because this is your hard-earned money that's going towards your goal of retiring early, giving to your kids, whatever that kind of looks like. And there's all kinds of intricacies on top of that, but this kind of underperformance is terrible. So the thing, because we were talking about it, is a lot of the S&P 500 companies, which people are already invested in their 401k, etc. Most of these companies are international companies. That's where the globally has morphed over the years, especially starting in 2000. So most of these technology companies are 40, 50, 60% of the revenue comes from international. Coca-Cola is at like 51% plus that comes international.
Yeah.
You mentioned McDonald's.
Over 80%, yeah.
Which is like the American brand.
Right.
Right? And so all these companies are getting so much of their revenue already internationally. They already have to deal with the rules, regulations, currency exchange, etc. So why are you, if you're adding the extra international, which has underperformed, it just makes it worse, because a lot of times the best companies in the world are still U.S. companies.
Yeah, and I think that is what is so important. And a couple of the notes we had here, for why has the U.S. dominated? A big one is lower corporate taxes, okay? Lower tax rates, corporations like to be here. We also have less of a regulatory burden. I was over in Europe each of the last 2 summers for my older son and then my second son when they graduated, and we went over there. And it's just crazy to see all the rules and regulations and red tape over there. When you talk to people, they say, look, I'm not going to start a company because it's just too hard. There's too many things that I have to deal with. The other thing is, on that note, is what has been the best sector over the last 15 years? It's been tech. And if you think of what are the biggest tech companies in the world and the best run tech companies, Microsoft and Apple and Amazon and Google, they're all here in the US. And if you think hey, who in Europe or Asia are the big tech companies that have done really well? It's hard to find any that can compare there. And so, of course, it makes sense to invest more in the US. And you make a great point. You already are getting international exposure when you own these US companies. Why overweight by having an extra 20, 30, 40% in international stocks? Now, that's a big part that we wanted to talk about, a major red flag. There is another red flag that is something that, quite frankly, used to be something that no one had to worry about at all, which is taking a look at your bond performance, okay? Because the truth is, in the 80s, the 90s, the 2000s, you could throw a dart at a dartboard with all the bond funds out there, and you'd make 5, 6, 7% per year most of the time. It didn't take a lot of work there. And then all of a sudden, things changed when COVID hit and interest rates went down to near zero. We have a chart here taking a look at a bond mix from 2021 through up until recently. And what we highlight here is at the start of 21, there's a little bit of a start. That is when we made the decision to sell out of the typical bond funds that are kind of total return. These were popular funds that you could, again, make 4, 5, 6%, but all of a sudden, start of 2021, interest rates are under 1% for a 10-year treasury bond. So what that means is when those rates went higher, which they can't go much lower than that, right? When they go higher, bonds can lose money. So take a look at the chart, and here we have the aggregate bond index. That's the equivalent of the S&P 500s or the Dow Jones for the bond market, right? And then we also have here, and that's in purple, by the way, in orange, We have the 20-year plus U.S. Treasury bond fund, because let's face it, this paid a little bit higher interest rate. So you had a lot of people who were at or near retirement who the advisor said, hey, let's buy some of these other bonds and make a little bit higher interest rate. Well, this chart is looking at how far off the high is the bond, including the interest you receive. So you're getting your interest, but these fell so far in price. Take a look, by the time we get until late 2023, so you're talking at that point, or late 22, you're talking at that point almost 2 years, the Barclays Aggregate Bond Index is down 18%. And if you take a look at the longer term US Treasury bond fund, it's down around 40%, went on to drop almost 44 late 2023. And I know you experienced this as well. There were people who got their statements, saw that they were down 20, 30, 40% in their bond funds and had heart attacks.
Oh yeah, it's supposed to be conservative. So I'll go to why bonds 101. I'll throw this in here.
Yeah.
How does a bond work? Why do advisors use bonds? Well, it's considered a conservative investment.
Yes.
The reason being is that the principal is guaranteed. So it's not a CD, but it responds somewhat similar to CD with caveats. So I would explain this to my bank clients because I was on the bank side for a while.
Yeah.
If you had a CD from a bank that was paying 5%,
yeah.
Okay, so you put $100,000 in the CD paying 5%. The next day you walk out, interest rates change on you, and all of a sudden that same bank is paying that same CD for 364 days now, but it's paying 10%. Okay, and you had it for 5%. Well, if that 5% pays your bills, you can just hold it. You're fine. But if I had the ability, I could go and say, "Hey, Will, will you pay me my $100,000 because I'd like to get some cash out, some liquidity?" Well, you're not going to pay me $100,000 for 5% when you can just walk into the bank and get it 10%. No, I'm going to have to discount it. I'm going to have to make up that difference. So I might have to take that 5% difference and have a little bit of a 5% loss. Now, the principal's still guaranteed by the bank, so that's why you're not going to lose your shirt in it, but that's why it has some drops. And so you take that same kind of concept, you multiply it over 5 years, 10 years, even a 1% drop over a 10-year period or change means you might make an extra 10%. Or lose an extra 10% on long-term bonds. So if we're at good interest rates, makes sense. We're at the highest rates we've seen in the longest time on the 10-year. But back a couple years ago, that was terrible. You were setting yourself up for disaster. And so by being proactive like you were, by being proactive with clients and thinking through this, it helps avoid some of these pitfalls. But that guarantee, the underlying guarantee from these companies is why these are considered conservative. But the market metrics as well, and the timing, going back to your timing point of earlier, the time in which you need the money is what gives it the risk. And so being smart about your conservative investment makes a ton of sense.
Yeah. So red flag number 2, when we take a look at portfolio, if you have had a large allocation to international stocks over the last few years, that has been a red flag. And if you have been in just these same kind of bond funds for the last 4 or 5 years consistently, that has not been good management. That is a red flag as well. Red flag number 3, owning target date funds, but not knowing how they work. And so this is a concept that kind of evolved because for a long time in 401k plans, employees weren't sure, hey, I have a list of mutual funds I can invest in, but I don't know which ones to invest in. And so they would pick a fund or 2 or 3 up front and never make any changes the rest of the way. So all of a sudden, industry decided, hey, let's buy a fund where someone can say, look, here's when I'm planning on retiring. All I have to do is buy the one fund, and as I get older, it gets more conservative as we go along to try to match when I'm retired. Here's the problem, is that every fund company has much different allocations for how to best get that done. And what really hits this home, and we keep going back to 2008 because it's the best illustrator, in the year 2008, the S&P 500 dropped 37%, okay? The target date 2010 retirement funds. So if you were 2 years away from retirement, the Oppenheimer target date fund for 2010 dropped 41%. Alliance Bernstein down 33%, and John Hancock down 30%. These are massive losses. And if you were 2 years away from retirement and you had these kind of losses, now all of a sudden your retirement goals are dumped upside down. And the problem is, even today as it stands, if you go to a Fidelity, Vanguard, or any of these companies and you buy that without doing an x-ray look at, well, how do they allocate the money, you're going to get different outcomes.
Yeah, I mean, it goes to, if you, let's say one worked perfectly. Let's say it went perfectly, was the correct amount of conservative to aggressive when you were about to retire a year or two before, and it does this. The problem with these funds is you're putting all your eggs in one basket, and therefore you're taking it all out of one basket. So let's say even on your own, you'd still be 50% stocks, 50% bonds. Market drops. Well, typically bonds don't drop as far as the market does, right? And so when you need money for retirement, you go to the bonds that are being stable, which is how we set up different portfolios. So you go to the conservative stuff that doesn't move, and you pull it out from there. But if they're all in one basket, that means you're forced to be selling out of stuff that could bounce back really good just to get at the stuff that's staying stable. And so just even if it worked perfectly, it doesn't work perfectly. And so it's going into and go, hey, the concept is good, but the how it's actually implemented is very flawed. And then you have clients that, I've had clients where they have a 401k here, an old 401k there. These fund managers all manage them differently. Some of them are good. Some of them have performed really well the last couple of years. So not saying that they're bad, but they're set up differently. You don't realize they might have one company has a ton of international, one has very little international. It's all across the board. And some of it's this lack of transparency of knowing what it is. And if you looked it up, usually we'll use the Alliance Bernstein. Inside of it, it's probably all of Alliance Bernstein stuff. So you have all Alliance Bernstein large cap and small cap and international. Versus potentially just getting the best one in each category, or again, hopefully towards your plan that you're going to do.
And add to that if we got 100 people in the same room and they all said, hey, we're retiring in 2 years, they all are going to be much different. Their personalities, right? One's more frugal, one likes to spend more, what their other assets are, what their Social Security may be. These are different. Yet we're saying use the same fund for all these people. That doesn't work well. So if all the money's in one of the target date funds, that's a red flag. Red flag number 4, and we're talking about dividend paying stocks. And we want to be clear that oftentimes companies that pay dividends, that are increasing those dividends on a yearly basis, that is often a sign of strength. We have the Vanguard Dividend Appreciation ETF in client portfolios. It has companies like Microsoft, JP Morgan, Eli Lilly, Visa, Johnson Johnson, Walmart. Companies everyone knows, right, that have been around a long time. However, the mistake comes in is that people start to think the higher the dividend, the better. Most of these companies are paying 3% or 4% of their share price over the years. And that was good especially when it used to cost $10, $20, $30 to go and sell a stock.
Yeah.
And so that was one thing. Another thing that we noticed here is that as time's gone by, there have been companies that have tried to take advantage of this. And so they sell the idea that, hey, you can come buy a fund that's not publicly traded, that's paying 6, 7, 8%. And people think that's really good. The problem is when you look under the hood, there can be trouble. And we have some examples of some of those companies. Ford Motor, AT&T, Verizon, Pfizer. These are companies over the last 10 years that have had high paying dividends, 5, 6, 7%. The higher it gets, it's basically the market saying, we think you're going to be cutting your dividend. And let's take a look at their returns over the last 10 years. The S&P 500 before dividends up 237%, with the dividends, 298%. So that's an example. That dividend income has been nice. That's added to your return. But if we take a look at those other companies, Ford Motor over the last 10 years, the price has actually declined 6%. AT&T down almost 6% as well. Verizon down 13% and Pfizer down 18%. So yes, with the dividends you can see there, you've gone into positive territory, but you've made a fraction of what you would have made in the S&P 500. And if we put the dividend, the Vanguard dividend fund in there, it's up well over 200%. So that's an example of what we like. We want companies and we want to own companies that are paying good dividends, but we are not out looking for the highest paying dividends. That is normally a major trap. And if you see that on your portfolio statement, that's a red flag. Well, that is a wrap on the most important portfolio red flags. But just a reminder, we have a longer list because there are other flags as well. You can click the link down in the description, or you can go to sentaracapital.com on the home page there and sign up. We will send you the list and a lot of important ones in there. We also want to mention that if you are new to Sentara Capital and you'd like us to look over your portfolio statements, go to sentaracapital.com. You can go to the contact page and reach out to us. We'd love to have a conversation. Thanks for watching and take care.